Hello, everyone. My name is Raman Uppal, and I'd like to welcome you to another edition of the CAFFE seminar. Laurent Calvé and Kim Pynenberg send their apologies because they're teaching, they're not here. But we have two exciting presentations on expectation formation. And the first paper will be presented by Kathrin Schlafmann from Copenhagen Business School, who will talk to us about expectations and wealth heterogeneity in the macroeconomy. So, Kathrin, the screen is all yours.
Well, first of all, thank you very much to the organizers, Raman, for inviting me to present this paper. This is a joint paper with Tobias Breuer, Alexander Kohlwas, and Kurt Mittmann, and it's on expectations and wealth heterogeneity in the macroeconomy. Okay, so what is this about? If I'm looking at the last, say, 10 to 20 years, then there were two main developments which are important for this paper that we see. So the first one is that there's now pretty much a consensus that inequality matters for macro and vice versa. So after the Great Recession, there was a lot of emphasis on investigating what drives inequality and what are the effects of inequality, wealth inequality in particular. So that's the one piece. But then the other one is that there's also been more and more evidence that the FIRE benchmark, so that is full information rational expectations benchmark, that is very restrictive. So in particular, we have now ample evidence that expectations are heterogeneous, so people do not have all the same expectations, and information is dispersed and limited, so not everyone knows everything. Now, if we look at current models which are used for policy analysis, these current models, they typically now embrace the first bullet point. So we use Hank models, heterogeneous agent models, to think about policy, but they do not yet include expectations or heterogeneity in expectations. So that means that these models are actually not able to answer whether heterogeneous expectations, whether and how they affect the economy. So they cannot answer whether heterogeneity in expectations affects the dynamics or the business cycles of the economy. It cannot speak whether there is an effect on wealth inequality or also some interrelation, some feedback for that. And ultimately, we cannot say whether heterogeneous expectations matter for policy, so how policies work. And this is where our paper here comes in. So what we do is we want to combine these two pieces and build a rational framework where we incorporate that people have heterogeneous expectations. So we want a framework where people optimally make their decisions about acquiring or processing information, and hence we have an endogenous development of expectations. More precisely, what am I going to show you today? So I'm going to start with some motivating evidence where we look at survey data. And what I'm going to show you is that there is a systematic wealth-related heterogeneity in households' macro expectations, so what people believe about the macroeconomy. Not everyone has the same expectations. And importantly, there's a systematic relationship between how wealthy an individual is and how good those expectations are, or how precise those expectations are. And it's a non-trivial relationship. And then this motivates us to, in fact, incorporate endogenous information acquisition into an otherwise standard policy framework, an incomplete markets framework. And then the main part of the paper, really the core of the paper, is to build that framework. So this framework builds on Krusell-Smith 98, so really the kind of fundamental classical Krusell-Smith model of heterogeneous agents. That is an incomplete markets model, so it has heterogeneity in wealth, and importantly, it has aggregate risk, and it's solved fully non-linearly. So we take that, and into that we now introduce rational information choice in a fully dynamic way. So people come in with a prior about the macroeconomy, and then they optimally decide what information to acquire or which information to process, and then they act based on the updated information that they have. And the next period, again, they come in with a new prior, which is the result of the behavior today. So that means that we're going to end up with a model which has a two-dimensional endogenous heterogeneity. The classical dimension that we already have in the Krusell-Smith model of wealth heterogeneity, but then also the second dimension, and that is information or expectations, and endogenous development of that. And we're going to, first of all, show that that in fact creates expectations, which is in line with this motivating evidence. So this model naturally produces exactly this relationship that we see in the survey data. And then second, we also show that it's important to actually take that into account, because we show that this information wealth nexus is really central for the dynamics of the economy. So it amplifies business cycles. It's important for inequality, and we show that it really affects what the effects are of macro policies. Okay, so let me now go in a bit more detail into these two parts. So on this slide, you see the motivating evidence. So here we use data from the survey of consumer expectations, so the New York Fed survey. And this is about expectations about the unemployment rate, so the aggregate unemployment rate going forward. And in the left graph, we plot the absolute error relative to the average error. So 0 is the average error in the sample, and then split up by the wealth percentile of the respondents. Otherwise, everything is unconditional. And we see that, in fact, the lowest, the households with the lowest wealth have smaller absolute errors. So they have better expectations than the middle wealth group. And then again, the higher wealth people have also good expectations, or better expectations. But it's otherwise unconditional. So in the right graph, instead, we now regress our absolute error on an individual basis on individual observables. So age, education, employment status, and crucially, the wealth percentile. And here what we're plotting is the coefficient on the wealth percentile, where the highest group is the omitted group, the wealthiest. And what we see is that also here, well, first of all, we see that the wealthiest households, they have the most accurate predictions, something that what we would intuitively also expect. But importantly, the lowest percentile actually has better expectations than the middle group. So there's this non-linear relationship between the precision of the absolute error, the quality of the expectations, and wealth. So this motivates us to incorporate this endogenous information, so to optimally choose what information to acquire, and we're going to show that that is non-trivially related to how wealthy you are, and it's going to produce such a relationship. Okay, so what is this framework that we're using? I mentioned that we're going to build on the standard Krusell-Smith model, and now with a modified information structure. So we let people optimally decide which information to acquire about the aggregate economy, and that then leads to this two-dimensional endogenous heterogeneity, an endogenous distribution of wealth and an endogenous distribution of information or expectations. So let me give you two slides of the formulas, what this model looks like. And the most interesting thing is really the households. So we have a continuum of households, and they maximize their expected discounted lifetime utility. So they have CRA preferences, and then let's ignore this part for a moment. I'm going to come back in 2 sentences almost. So they maximize discounted lifetime utility subject to a budget constraint. So they have available, what's on the right-hand side is their cash at hand, all the resources that they have. So they come into the period with some wealth, with some capital K, they get a return on it. And then they're either employed or unemployed. This is the epsilon. So if they are employed, then epsilon is equal to 1, in which case they get a wage rate W for their labor supply, and they need to pay taxes on it. In the opposite case, if they're unemployed, then epsilon is equal to 0, and this next term here is relevant. In that case, they get a fraction mu of the current wage rate as unemployment benefits. And finally, their capital depreciates, so delta is the depreciation rate. So these are all the resources, their cash at hand that households have that they come in. And what can they do with it? They can either consume it or they can save it. So the optimal decision is how much to save to maximize your discounted lifetime utility. So this is the standard Krusell-Smith model, with the exception of these two terms that I've so far told you to ignore. And those are the new information costs that we put in. So we have the first one, this kappa here, that is a utility cost, and it's random. So it's an IID draw each period, a type 1 extreme value shock, how much effort you need to put in to process the information. You can think about it that way. And the second one is a monetary cost that you just need to pay from your budget constraint. So these are really the two new elements in the household problem. Then I haven't told you yet what you actually want to learn information about. So you want to learn about the aggregate economy. So let me go to the next slide and let me tell you what these things are. So this is where the firms are important. So firms are standard. They operate on a Cobb-Douglas technology. So this is their production function. So output overall depends on Z, which is the productivity shock, which can be which follows a first order Markov process. So we're either in a boom, Z is high, or in a bust, Z is low. So two states, boom or bust. This is the Z, this is the aggregate state of the economy. And then we have aggregate capital. And that is the aggregate, the capital K. And now we assume that also the labor is in fact labor, or the reverse, the unemployment rate is directly tied to the state of the economy Z. So that really it's only the productivity and aggregate capital which determines output. And the rental market for capital and the labor market are assumed to be perfectly competitive, which means that capital and productivity together directly pin down the wage rate and the return on capital. And this is important because what people care about when they make their savings decision is they need to form expectations about what tomorrow is going to be their wage rate and the return on the savings that they get. And in order to forecast that, they need to know what they think tomorrow's capital is going to be and tomorrow's state of the economy, boom or bust, is going to be. So that's what they want to learn about. But that's what they want, what they care about. And finally, just to close the model, the government is boring, so they just run a balanced budget. They raise exactly as much taxes to pay the unemployment benefits each period. There is a question, I think.
Yes. Hi. I was wondering what's so the forecast errors you had before. Sorry to go back to that, but that was for the aggregate economy.
Yes.
Is it the case that you want to forecast the aggregate economy, or kind of your part of it? So this error that you take for the low wealth households could be that they're just forecasting a different labor market than what the rich are doing, and maybe that doesn't matter. But yeah.
So the way it's phrased, it's about the aggregate unemployment rate. What the but you're right. In principle, we don't know what people are thinking about. But under the assumption, the way it's phrased, that it's about the aggregate, they're asked in the likelihood that the aggregate unemployment rate is going up or staying the same or going down. This is, I was a bit fast on how we construct those errors for the motivating evidence, but it's phrased as the aggregate unemployment rate.
Okay, thank you.
Okay, there are more questions about just the setup before I now go on. No, okay. Perfect. So this is the model. It's basically two slides, but it's fairly complicated to solve because it ends up with this two-dimensional heterogeneity. In particular, we have this double infinity problem of the aggregate states. So we have the kind of classical problem of all the heterogeneous agent models, like Purcell-Smith, that we have the infinite dimensionality of the cross-sectional capital distribution. So basically, what we need to know tomorrow is aggregate capital. But in order to forecast that, that is the result of how much everyone in the economy saves today. So in principle, I need to know the whole distribution today to forecast accurately what the sum of all of that is going to be tomorrow. That is already part of the Purcell-Smith. And now we have, in fact, a second one, because we also have the infinite dimensionality of the beliefs, because everyone comes in with different beliefs. So let me talk first about how we deal with the first one. So the standard strategy in this incomplete markets model, in the absence of incomplete information, is to assume that instead of tracing out the whole distribution of capital, it's enough to know just a few moments of that distribution. So for example, the mean, the variance, and so on. So a finite number of moments. And then it's assumed that people form kind of boundedly rational expectations based on those moments. So not on the full distribution, but just on the moments of the distribution. And then the standard assumption is that it's exogenously specified which moments this is, and all the agents in the model have common knowledge about it. So everyone knows the state of the economy, and everyone knows exactly all those moments that are pre-specified that should be used. What we do now instead, I mean, we do something similar, but you can think about it as relaxation of that, because we now let people optimally decide what to learn about, if they want to learn about Z, and which and which of the moments they want to use. And then we let households optimally to choose those, and then they form they form these boundedly rational expectations based on what they've chosen. But that still doesn't help us with the infinite dimensionality of our expectations. So here we have this problem that in order to forecast what capital is tomorrow, I would need to know what everyone saves today, but that is a function of what everyone believes about the aggregate economy today. So I would need to know the whole distribution of those expectations. And not only would I need to know what everyone believes themselves, I would also need to know what they believe about the others. So I need to know what I believe about the economy, but also, for example, Claes is going to save. I need to know what he actually thinks about the economy in order to know what he's saving. And I need to know what he thinks that I'm thinking, because then that's also going to influence how much he's going to save. So this is not a new problem. So this goes back to Townsend 83, and it's also a problem in our setup here. So what we do to get around that is we use two pieces of evidence to simplify the problem. So the first one is that Wouters and Hahn has shown in this model of the kind of Purcell-Smith world, if you know the whole sequence of these productivity shocks said in the past, if you know all of these, then you have very accurate predictions about the future capital stock, even if you've never actually observed the capital stock. So that's very useful. So you don't need to observe the capital stock if you have enough observations of the past productivity shocks. And second, in the companion paper that we wrote ourselves in a model where you do a once and for all decisions and not a dynamic model, we show that the utility benefits of actually learning about capital are very small if you already know the state of the productivity, like the productivity state if you're in a boom or in a bust. So taking that together, we in fact let people just learn about the aggregate economy. Just learn about the aggregate productivity state. So that means that people can now decide, they come in with a prior, what is the likelihood that we're in a boom? Everyone has a different belief about that. And now they decide based on their individual states of cash at hand, of employment state, and about their prior, whether they now want to learn whether we're currently in a boom or in a bust, whether they want to learn the truth. So that makes it feasible to actually make that operational. So we calibrate this model after to like mostly standard US business cycle statistics. And then what's crucial for the calibration, the internally calibrated parameters, is the discount factor, the relative risk aversion, and these two new parameters for our information choice. And we do that to match the mean absolute error and the standard deviation of the dispersion of these absolute errors that I showed you in the motivating evidence. We do not target the shape of with wealth, just mean and standard deviation. And then what we find is that in fact we have non-trivial interactions between the wealth distribution and the information, the incentives to actually learn about the economy. So this is let me explain what we have here on the slide. So you see a plot where you have all the individual state variables. So we have the employment state, the unemployed on the left, the employed on the right. Then we have cash at hand, the other idiosyncratic state variable on the x-axis in each graph. And on the y-axis is the prior that you come in with. So your belief about the likelihood that we're currently in a boom. And then the heat map, the heat plot shows us the brighter the color, the more likely you are now to actually acquire information or to process information. The higher is your incentive to do that. So let me walk you through what's happening here. And let's start with the employed. They are the easier to understand. So the employed, we see that essentially the richer you are, the more incentives you have to acquire information. So the employed, they are the savers. And the richer they are, the more they're going to save, the more important it is for them to know what is the interest rate that they're going to get on those savings. So the richer they are, the higher the incentives. On the other side, the unemployed, for them it's less trivial, and here it's nonlinear. So the unemployed, these are the dissavers. So they use up their savings in order to smooth consumption. And on the very left here, we see these are the poorest. They are not acquiring any information. So they have no incentive to learn about the aggregate economy. And the reason for that is that these guys, these very poor households, they would never acquire the information. They are constrained, so they're not saving at all. So whether or not they learn about the information, they can't use it because they're at their borrowing constraint. They're always saving exactly zero. So they can't use the information, and hence there's no reason for them to spend any effort or costs to acquire information. But then as they get slightly richer, you see that it almost jumps. So from no incentive at all to a lot of incentives to acquire information. And this is because here, these guys are in fact very close to the borrowing constraint, but they're not at the constraint. But making mistakes here for them means that they're in danger of hitting the constraint. And that is very, very nonlinear. So the costs of doing that are very high. The marginal utility is very high at that point. So it's very costly to make mistakes, and hence they really want to get it right. They have an incentive to acquire information. And then, as you can see, first they get a bit richer, so the danger of hitting the constraint gets smaller, so lower incentives. And eventually, if they get very rich, then it's almost the same effect as for the employed who are saving. There was a question, I believe. Is that Hector? Do you still?
You're on mute, Hector.
Yes, sorry. Hi, Kathrin.
Hi.
So I was wondering whether when the unemployed are borrowing constrained, for some reason they cannot borrow, and therefore they are not interested in learning about the interest rate, because then you would want to learn about that, right? So I was a bit puzzled by this result. But
the employed, they want unemployed, to build up.
Unemployed.
Oh, the unemployed. Yes.
The unemployed. If you are very cash constrained, you would like to borrow to smooth the.
I see. So in our setup, they are not allowed to borrow.
Okay.
I believe it would move our. There would be a region where they are basically where they don't save, and then if like some inactivity region basically where we would get this effect, and then as they get even worse, they would like to borrow. That I think you're right there. In our model, they cannot borrow.
Okay.
But I think you're exactly right.
Thank you.
Okay, so this is the incentives. What does that now translate to? And here we get. Okay, and here we get to the result. This is the red line is just a nonlinear fit to the data that I've already shown you, and then the model produces the similar dynamics. With the caveat, Hector has mentioned it, we don't let people borrow in our model. So that's why the fit, basically our model stops here. Okay, so in the last 5 minutes, let me tell you why we do all of this, why this is actually important to look at. So now what are the effects of allowing for this heterogeneous expectations? The first one is it affects the dynamics, so the business cycles. In the top panel, we have standard deviations of all our aggregate variables. And in the bottom panel, we have the difference in percent of our model relative to a benchmark where we have full information, the classical Krusell-Smith. Let's focus on this bottom panel to save the time. So the benchmark model is our model, and then the exogenous information model is a very similar model, but we don't let people optimally decide to get information. They randomly get information. And the average likelihood of getting information is the same between those models, but there is no endogenous decision. And what we see, first of all, is that we have, this is in percent, so huge increases in the volatility of the economy. So we get substantially more pronounced dynamics. And that comes from that the uninformed households, they make worse decisions. So in particular, if we're currently in a boom and you don't know it, then you are systematically underestimating the actual capital stock, which means you're overestimating returns. So you want to save more. So you save too much relative to what you would do if you knew the true state, and vice versa in booms. So people oversave in booms and they undersave in busts, and that amplifies the business cycles. And we also see that is particularly pronounced. So we see that we have a larger increases in our benchmark model relative to the exogenous information model. And that is because And that is because the bulk of the savings is done by this group who's least informed. Okay. The second result is about inequality. So I motivated this whole thing that wealth inequality is important. And here we see that it actually interacts with information or expectations in heterogeneity. So what we see, again, focusing on panel B, which is the percentage changes relative to a full information model, we see that now it matters what measure we look at for inequality. So if we look at the 90-10 ratios, the 90th percentile relative to the 10th percentile, we see that limiting information increases inequality. People make worse decisions. There's a dampened correlation between the returns and savings, and hence we get more inequality. But we also see that it's really important whether we have actually endogenous optimal decisions or whether it's just exogenously random whether you get information. And that is, we see that the tail here in our benchmark model where you make optimal decision, actually, if we look at 99 to the first percentile, the extreme tail is less extreme. And that's because the very rich have the highest incentives to get information. They are actually very well informed. Versus in an exogenous information model where it's random whether these high wealth guys get the information. And then it's is very similar to a mechanism in Piketty and Sayers, which generates Pareto tails, where you have your savings rate is essentially linear with the slope depending on your expected returns. And if you now randomly get expectations, that randomly changes your savings rate, the slope, and that generates Pareto tails. But that is only the case if it's exogenous information, if it's random. If you optimally allow people to have endogenous decisions, then that is actually not the case. So it's important to distinguish here and to go the extra length to make expectations optimal, information choice optimal. And finally, the last result, this is about policy impact. So here what we do is a very simple linear wealth tax where we just tax wealth linearly and then we throw away the money. So this is not a serious analysis of whether a wealth tax is good or bad. This should highlight that allowing for endogenous information choice, in fact, alters how policies work or the effects of policies. So here we have our benchmark model, and again, and then what happens in a full information model. And we see, first of all, there's the direct effect. If you so you have a wealth tax because you want to reduce inequality, and the direct effect is, yes, you're taxing high wealth individuals more, so you bring down inequality. But now, if you allow for information choice, then by reducing the average wealth in the economy, you're also changing the average incentives to acquire information. And it turns out in our calibration here that lower wealth implies that less information is optimal for people. So the whole economy is less informed, they make worse savings decisions, and that in turn, again, increases inequality. And we see that the second effect, in fact, can overturn. So we have here a higher Gini and a higher extreme tail relative to when we introduce the wealth tax. Whereas in the full information world, you just would not get that because you're reducing, that's only the direct effect. So it's in fact important to allow for this information channel or to think about the information channel when you think about policy. So let me summarize. What we do in this paper is to allow for heterogeneous and endogenous information choice in an otherwise standard incomplete markers heterogeneous wage and framework. And what we find is that there is a meaningful two-way interaction between the heterogeneity and expectations and the wealth inequality or precautionary savings. And that means if we disregard the heterogeneity information, then we have a problem similar to the Lucas critique. So if we think about policies which affect the wealth distribution, that actually changes the incentives to acquire information. So if we don't take that into account, then we're missing part of the effect of the policy. And also relative to the heterogeneous expectation literature, they typically work with linearized models. What we showed is that these are really very non-linear dynamics that we see, or non-linear interactions. And those cannot be captured if we just look at the models which are typically used to think about heterogeneous expectations. Thank you very much.
Thank you, Kathrin, for a very clear presentation, excellent slides, and it's very well presented. Thank you. So we can open it up for questions now. You can either raise your hand or just go ahead and ask a question if you have one.
Both works for me. Claes, I think you raised your hand. Maybe you want to start.
No, it was a clapping.
Oh, it was a clapping one. Okay.
So Kathrin, I can ask, like, the heterogeneity in wealth, which are the aggregate variables that it affects?
In the absence of the
No, with information differences, is it an interest rate channel? Like, which are the equilibrium quantities which are affected by heterogeneity in the wealth distribution?
Yeah, so the heterogeneity in the wealth distribution. So ultimately, what we need to know is the aggregate capital tomorrow here, and that is affected both by the heterogeneity in wealth and combined with the heterogeneity in what people believe, because both together determine how much they save, and hence the sum of that, the aggregate wealth tomorrow, the aggregate capital tomorrow. So it's really the interaction of who has a lot of wealth and at the same time good information, because they make the best decisions. Or if the very wealthy who save the most, if they have very poor expectations, then that would have even stronger effects from having limited information. That's why it's important actually to have this endogenous information choice. And it's not kind of in a more make you right. Basically, if you don't have the Calvo ferry, which would just randomly give you updated information, you wouldn't get that interaction. So then that's what you're missing, kind of, that there's actually wealth is important for how much incentives you have to learn about the economy.
You don't have a stock market in this model, so would the results change if there were financial assets?
So we haven't done it, but I would think that it would still all go through, because the richest have the most exposure to the stock market, and they already here have the best expectations, the very rich. So I would think it might change the quantitative results of the exact numbers, but the principles should still be the same.
Yes, I think so too. Like, I think it will go through.
Mm.
So, yeah. Okay. Any other questions? Okay.
This one is a more speculative question, or an invitation to speculate. Do you think there are other important deviations from FIRE that interact with heterogeneity in Hank models, wealth heterogeneity, for example?
So I think what we do here in the paper is we don't really take a stand on that there can't be other things which explain this motivating evidence. In the motivating evidence, we're showing correlations. So we just show that naturally, actually, out of a fully rational choice, so no biases, this comes out. But that does, of course, not mean that there is no such thing happening. We're showing that some of the components are already there without biases. But I'm sure if you have some more, also if you have different types or different, that how difficult is it already to process the information, then you would get even more heterogeneity. Or I guess what matters is if these in our context, if you would have these biases linked to wealth, kind of if you also have higher income and hence higher wealth, and then stronger biases or not, that would kind of change a bit who has the best information. To think about that, but we're not taking a stance here. We're just showing if everyone is otherwise ex ante exactly identical, and then just by the fact that we have this heterogeneity in wealth, that alone already gives incentives which are in line with the motivating evidence.
Very good. Thank you. Richard, go ahead.
Yeah, can I ask one question? Thanks for the presentation, Kathrin. So I was wondering, there is another source of uncertainty, which is the individual unemployment state, right? I was wondering, did you experiment? And people, I guess, are perfectly aware of the distribution of that. I was wondering, probably for the individual, it will be more important to know the probability of being unemployed or not next period, as opposed to the aggregate Z, which doesn't vary too much in this model. I was just wondering whether you experimented with that as well.
So in fact, if you look here, it does play a role, because we had, maybe I was fast on that when let me just go to all the way to the model definition here. We have that the aggregate unemployment rate is directly tied to the states of the economy. So we have a higher unemployment rate in busts than in booms, and people are aware of that. So basically, by learning about Z, that goes into, for the unemployed in particular, it's very crucial to know what is the likelihood of finding a job tomorrow. So that is one of the key drivers why they really want to get it right at the boundary. Not so much because they care about the interest rate, because they don't save much. They really care about their employment prospects and the wage that they get once they are employed.
Okay, thanks. I missed that part. Yeah.
Hector?
Yes, a very quick one, but might not be an easy one to answer, Kathrin. So I'm thinking about how do you solve for the equilibrium in these sort of models? And I'm thinking that, there is this old paper by Helwig and Belkamp that says that if you you're playing a game with strategic substitutes, you normally want to know what others know. Sorry, with strategic complements. If it is with strategic substitutes, you want to know what others do not know. So here, because you have this endogenous information choice, and because they are all learning about the same thing, and basically you have a general equilibrium structure.
Yes.
If they all learn about the same thing, essentially, but I don't know if this is right, the interest rate is going to go down, right? There's going to be more savings, more capital stock. So everything else equal, the interest rate is going to go down, which is going to make it. So I'm thinking, so are there multiple equilibria? And if there are, is it strategic substitutes or strategic complements that is going on?
Okay, so one thing that I haven't, so basically they have the individual state, and the way we get around that they don't need to know what you believe or what everyone else believes and higher orders is that we assume that they do know the law of motion of the economy, the aggregate law of motion, and then it's determined. So there is no multiple equilibria once they know that.
Okay, so you get rid of the forecasting the forecast of others, and now, so what remains is a unique equilibrium, or do you see that for different parameter configurations, because you still have heterogeneous expectations and heterogeneous agents, right?
Yes, we have heterogeneous agents and heterogeneous. So we didn't prove that there is a unique equilibrium. We didn't prove that. Numerically, when we ran it, we didn't run into that problem. That's as far as I can say. But we know that your own individual state is important about what you believe. And then, given that you know whether we're in a boom or a bust, we have the aggregate law of motion, which is different for the boom or the bust. And you know the true, for your economy, what is that law of motion? So the fixed point, essentially. Yeah. We assume that you know, standard to the Crusell-Smith framework, what they do.
I see. Okay. Thank you so much.
Thank you. I think we should move to our second speaker, who's Peter Andre.
Thank you very much.
Leibniz Institute for Financial Research and Goethe University, Frankfurt. He's going to talk about mental models of the stock market.
So I will talk about a new paper today, Mental Models of the Stock Market, joint work with Philipp Schirmer, a PhD student at the University of Bonn, and Johannes Wohlfahrt, who is at Cologne. So we're going from macro deep into micro now. We still talk about expectations, and we try to understand better how return expectations are formed on financial markets. The focus is going to be on stock markets. Now, why is that an interesting question? Obviously, stock markets are inherently about the future, and hence return expectations matter a lot. Past research shows that return expectations shape trading decisions. The heterogeneity can generate trading volume on markets, and anomalies in return expectations, for example, return extrapolation, they have been linked to market phenomena such as momentum, reversals, bubbles, things economists care about. So understanding how return expectations are formed, that's a key interest for economists. And our starting point in this project is that investors will likely form their expectations in light of their deeper understanding of the stock market, which is what we term mental models in this project. So their views on how the stock market works and how returns arise on markets. I think it's fair to say that these views remain a black box for economists. The data that we usually study, pricing data, trading data, even data on subjective expectations, they remain silent on what's going on in investors' minds. And we want to fill this gap. The goal in this project is to shed light on this black box and study the mental models of the stock market, of different investors. This is a broad question, and to narrow it down a little bit, we contrast three classes of views: market efficiency versus temporary mispricing versus equilibrium neglect. And I will tell you more about all of this in the next minutes. Now, the key challenge that we face is how do we manage to measure these mental models, to collect empirical evidence on these mental models. And to illustrate our approach, I would like to run a quick thought experiment with you. So please think about two scenarios. Scenario one, which is here in the upper left corner, there, 4 weeks ago, news was published on a company that is traded on the stock market. The news is very neutral. Basically, nothing unexpected happened, no new information. This happened 4 weeks ago. Now contrast this with the scenario in which for the same company, pretty good news arrived 4 weeks ago, indicated here by the dollar bills that fall from heaven. So in this scenario, industry experts learned, traders realized the earnings stream of that company is going to be much higher in the future. But these both news, they broke 4 weeks ago. And I'm going to ask you one question. You invest today, 4 weeks after the news came out in both scenarios. In which of the two cases would you expect a higher return for the next year? Okay, and then depending on how you think about the market, you will likely give a different response and explain it in different terms. If you believe in efficient markets, then you would argue that certainly after 4 weeks, stale news are priced in, prices responded, and now the news are no further predictive of future returns. Expected returns are similar in both scenarios, unless the risk properties of the underlying asset changed. If you believe in temporary mispricing, then you believe that markets at least temporarily can deviate from efficient prices for various reasons. You might believe that the market underreacted to the news, which means that the stock still has to appreciate in scenario two, so return is going to be higher there. You might believe that the market overreacted to the news in scenario two, so a reversal is coming over the next months and returns might actually be lower in scenario two. So if you believe in temporary mispricing, then you believe that a difference in returns across the two scenarios can arise, and you will explain that with a story for why the market deviates from efficiency. These are the standard views on the stock market that academics discuss. But if you talk to people out there, if you interview households, then it becomes quickly clear, and this is going to be one of the central results of the study, that you need to take a third view into account, a view that neglects equilibrium pricing altogether. This view basically argues, well, in scenario two, we can expect higher earnings for the future, and that's great, so returns must be higher as well. So this person is basically, you ask that person the question, in which scenario will the stock perform better? And the person is just answering in which scenario the company is going to be more successful. This link, the link between expected earnings and expected future returns, is of course shut down in equilibrium due to equilibrium pricing, either because prices incorporate all information, all available information, or at least, not partially. But people who neglect equilibrium do not take price adjustments into account at all and think that higher future expected earnings are indicative of higher expected returns. Now, this thought experiment is very revealing of people's views on the stock market. And if we elicit expectations, if we ask for an explanation, if we run additional experiments, we can actually learn quite a lot about how people reason about the stock market. And this is what we do in this project. It's basically a big thought experiment that we run with very different investor groups. And yeah, thought experiments. We do this with samples from the general population in the US and Germany, with retail investors in the US and Germany, with financial advisors in the US, with professional fund managers. So these are expert practitioners, and also with academic experts. And our goal is to better understand which of these views are dominant on markets. Just to preview two central findings to motivate you a little bit to stick around. We find disagreement in mental models quite important for market level implications, and widespread neglect of equilibrium pricing, even among some of the professional fund managers. All right, I return to the literature later, hopefully, if time is left. But now I want to tell you a little bit more about how we make this possible, how we measure these mental models in a survey-based approach that we field with different investors. So I told you already that we have a thought experiment with two scenarios. The ones that I presented to you, they were quite abstract, and I could do this because we share a language. We have, we have terminology to talk in abstract term about markets. We could replicate this with academic experts, but certainly not with households, not with financial advisors, maybe. So in order to make our approach comparable across samples and to make it relatable even for the less economically educated respondents, we focus on a very concrete and tangible example. The scenarios that respondents see are about the company Nike, the athletic company that you probably all know. And we ask people to think about two hypothetical scenarios. One is kind of a neutral news scenario where Nike just sticks to their previous supplier. Nothing unexpected happens. Industry experts were not surprised by the announcement, and so on. And the other scenario is one in which Nike announces really good news, a new cost-saving partnership that slashes raw material cost by 20%. Industry experts were pleasantly surprised, so this comes unexpectedly, dubbing this an unexpected success for the company. And then we repeat, these are old news, they received a lot of attention, and we make sure that people understand it. We have a quiz afterwards, a comprehension quiz, where we also ask whether these are recent, like very new news or 4-week-old news, and people cannot proceed if they don't get this right. So people understand this. And then on the next page, we ask them, you invest now, 4 weeks after the announcement, $1,000 for a year. And in which of the two scenarios would you now expect a higher return? Scenario 1, 2, or similar in both scenarios? We also listed quantitative return expectations in future periods, but I won't have time to talk about this. Immediately afterwards, on the next page, follows what is one of the key measures in our paper. Namely, we ask people to explain their response to us. And from these explanations, from the qualitative text data, we can back out a lot about their understanding of stock markets. Now, there are a couple of disadvantages here, right? I mean, the advantage is it's tangible, concrete, naturalistic. This is how news would appear in real life, but there are also disadvantages. It's a concrete example. People might associate very specific things with Nike and so on. It's hypothetical. Maybe people can't take it seriously. So I won't have time to show you this in full detail, but we replicate this in different types of scenarios with different firms, different type of news, with news about the aggregate stock market, with real news and incentivized forecasts, even with investment decisions. So I'm showing you here our main study, which exploits all of the advantages that we can gain when we work with these hypothetical scenarios. But the results has been shown we can show that this result is robust in many other settings. We can talk more about this in the Q&A. Quick note on the samples that we were able to collect. We interview the US general population and the German general population. Not all of them are active on financial markets. Some are, we have data on that. But we think it's also important to understand the views of those who do not participate in stock markets, because their views might partially explain why they do not participate in the stock markets. And I will return to that later. From these samples, I mean, different recruitment strategy, but we do, from the general population, we also recruit households from whom we know that they're invested on markets. We have such a sample from the US. These investors have a median investment of around 90K in the stock market. In Germany, we have investors who are with a median investment of 50 to 60K in the stock market, all high income respondents. These are retail investors, but we also want to shed light on the finance industry. And thus we recruited a sample of financial advisors, not only advisors, also some investors and analysts, but these are respondents from the lower segment of the finance industry, so to say, who are in contact with households and shape and their investment decisions. We also have a sample of professional fund managers. So here we collaborated with 2 large German asset management companies, and they send out our survey among their asset management teams that are responsible for managing $1 million or euro heavy funds that they coordinate. And as you can see, I mean, reflecting that this is a much harder sample to gain access to, we have fewer respondents here. And to contrast this with an academic benchmark, kind of the status quo view of academics on that issue, we also reached out to colleagues, maybe to some of you, many researchers who published in top finance or general econ journals, and about 100 of them participated in our survey. All right, so let me summarize. We have this idea to run a thought experiment that reflects mental models, and we run it with very different investor groups. Now let's have a look at the results. First, I focus on whether or not these investors predict that stale news are still relevant for future returns. Okay, and I will show this to you on one slide. And here you have the academic experts, and they say that the difference in returns is, I mean, the returns are quite similar across scenarios. This is what the gray color indicates. Green would mean good old news means higher returns for the future, and red would mean good old news, lower returns for the future, so a contrarian prediction. Academics, however, agree that by and large, markets are reasonably efficient in that context, and the old news won't matter for future returns anymore after 4 weeks. Now, among our households, US and Germany, we find very different results. So here you have the 2 retail investor samples, here the 2 general population samples. Most and the majority of households predict that higher good news are still relevant in the future. Sorry, I should be more, and this was imprecise. Past stale good news is still relevant for future returns, and good news means higher returns in the future. How about financial advisors, those who think about this in their working day life, those who advise investors, who advise households on these matters? They have pretty much the same views. They also think that stale good news still lead to higher future returns. How about professional fund managers, those who move millions on markets? Among them also, a majority predicts that the stale good news still matter for future returns. So there's a clear contrast between views among academics and views among everyone else. And we do not know yet where it's coming from. But we know that this is a good starting point to understand their understanding of the stock market. So let's go there next. Which mental models are underlying these return forecasts? And we draw on different approaches. I will mainly focus on one today, which is the explanation that participants provided us for their forecast. And I want to show you an example. Here are the responses, the explanations of experts. Experts argue in terms of market efficiency. They say in efficient markets, the information should be fully incorporated into the stock price 4 weeks after the announcement. So it won't matter anymore unless beta changes, which it doesn't. Or here's another expert arguing the effect on future profits and dividends should already be reflected in the current price. So no surprise, I guess. Experts think that stale news don't matter anymore in the future because they reason in terms of market efficiency. Let's look at households on the other side. Households argue the premise is that the only difference in scenarios is the supply chain issue. So this is a scenario with bad news about Nike. In scenario 2, a disruption in their supply chain would lead to difficulty in maintaining production and therefore income and therefore profits. So they argue how the news affects the future earnings streams, and that's their argument for why future returns are going to be different. Likewise, by changing the supplier, Nike is saving money, which would mean greater returns for them and greater returns for me. So if Nike has higher earnings, this means higher returns for me. And this is precisely what we dub equilibrium neglect. These households do not take into account that equilibrium prices will tend to reflect the information that is available on future earnings, and hence the link between expected future earnings of a company and expected future returns is broken. It breaks down in equilibrium, but this is what these households do not understand. Now, I showed you 4 example quotes, but we want to get a sense of the overall data. So what we do is we go through all of the thousands of responses, we hand code them into different categories, and here are the results. So among academic experts, we basically only see arguments in terms of market efficiency. Some mention risk. Among households, we classify every explanation that we can classify. We cannot classify all explanations. Some are too ambiguous or vague. But every classification, every explanation that we can classify, we classify as reflecting such an equilibrium neglect. Households argue in terms of higher sales, higher profits, and they forget that prices should have already incorporated that. Again, financial advisors, very similar than households. And for the fund managers, let me again stress, it's a 50-person sample as of now. We find heterogeneity. We find that many also, and many agree with the academics that markets will be efficient here. Stories of underreaction and mostly overreaction are also put forward, but we also still see a clear and reasonably large share of neglect of equilibrium pricing, even among these professional practitioners. Okay, so yes, I have to skip this, but let me just say that the approach has big advantages. We ask for an explanation. We do not offer them any explanation that we consider appropriate and reasonable. So basically, it's a qualitative approach. They can share with us whatever comes to mind. But maybe not everything comes to mind or is expressed by respondents that actually matters for the return expectations. So there's also a disadvantage here. And we try to address this a disadvantage with alternative approaches that, however, yield similar results. So, for example, for experts, we see that their return expectations correlate with their risk expectations, as it should in efficient markets and risk-based asset pricing. For non-experts, however, we see that expected returns correlate strongly with expected future earnings. And this is again evidence for equilibrium neglect. We also have an additional experiment with households. And even when we say to households that risk differences do not exist between scenarios, or that we say that markets already have reacted to that information and incorporate that information, even then they make similar forecasts. So all of that just establishes that while academic experts believe in market efficiency, household financial advisors and even some professional investors neglect equilibrium pricing. I have about 5 minutes. Yeah, I know. But I have a lot of material. So let me see how I can cover this. There are two more questions that we want to settle in this paper. One is on where is this equilibrium neglect coming from? And the other question is on what are the consequences? So maybe I give you a big picture overview. Let's first talk about the drivers. Well, it could be that households are simply inattentive to the past, to other traders' responses, to price changes. And hence, we ran an additional experiment where we asked households to think about what happened in the past, how other traders responded, how the prices changed. And if you run such an experiment, this is the control group replicating the previous finding, and ask people, what did other traders do in the meanwhile? 90% will say, well, they liked in the past 4 weeks, they jumped on the stock, they wanted to buy that stock. And if you ask them what happened to prices, they would say, yeah, prices increased. And then you ask them, and how about the future? How about future expected returns? They still make the same forecast. So this is not a matter of inattention to past trading and price responses. We think it's a misunderstanding, a gap in people's mental models. They do not understand what the response of traders and prices means for future returns. And to tackle this, we run an additional experiment where we explain equilibrium pricing to people and why expected future earnings do not necessarily mean translate into expected future returns. And this is the experiment that at least convinces about 20% of households that past news won't matter anymore for future returns. All right, so here our conclusion is that equilibrium neglect is a gap in people's mental models, not just a lack of attention to the past price response. People don't understand equilibrium. How about the consequences? Let me just say the following. Return expectations are so important for markets also because they are often not rational. And two important deviations from rationality are that people extrapolate from past returns and that they have pro-cyclical return expectations. So they think that returns are higher when the economy is expected to perform better. Both is not necessarily in line with rationality. Both can shape important market level phenomena. Both is predicted by equilibrium neglect. And this is what we show in this last step. We have expectation panel data from the Bundesbank online panel. And yeah, let's not go into the details here, but we see that those who are equilibrium neglectors, they have more pro-cyclical return expectations and more extrapolative return expectations. All right, I'm concluding. This is what we do in this paper. We study inference from stale news, which is widespread among everyone else but academic experts, reflecting often a neglect of equilibrium pricing, which comes from a gap in people's mental models. And this has consequences. And I have maybe 30 minutes, maybe 60 seconds left. And I want to talk a little bit about the consequences, also relate this to the literature. First of all, I mean, what we hope to provide is a new perspective on this huge literature on expectations in financial markets. We think it's important to understand investors' broader understanding of markets. And here is some direct evidence on that. And equilibrium neglect could explain a couple of anomalies that people have discovered in expectations and trading data. Yes, pro-cyclicality and return extrapolation. We even make this link in the paper. Overtrading, which is common among some retail investors, and response to stale news. These are puzzles in household finance that result from neglecting equilibrium pricing on markets. Perceiving high participation costs. So believing that you need to understand future earnings in order to identify good stocks. If you have that view, then it's quite difficult to invest on stock markets, and that might explain why some households don't do it at all or engage active investors for them. So a couple of these, we think, anomalies could have a common source in equilibrium neglect. And I also have a slide on aggregate consequences, but there I basically want to say theory that studies the aggregate consequences of imperfect understanding of equilibrium pricing is going to be quite interesting and relevant in light of our results. Maybe that's something we want to discuss now. I'm concluding here. Thank you so much for giving me the chance to talk about this work.
Thank you very much, Peter. That was very exciting. Like, it's good to see that not everyone understands finance and economics as well as academics do. So we can open it up for questions now. You can just ask, go ahead and ask your question, or you can raise your hand and I can call on you. So Hector, go ahead.
Thank you very much, Peter. So, and although I tend to agree with Raman, I was wondering what would Bob Schiller think about your findings regarding academics, given all his work against efficient markets. So, I mean, stated in other terms, I think that the notion of market efficiency is still contested in economics. And actually, the fact that we are finding so much evidence about forecast errors, on returns, opens up the big question of whether we are right in thinking that markets are efficient. So
yes, I fully agree with that. I think here it's important to stress that many experts predict markets to be efficient in treating the specific news that we use in our thought experiment, that specific type of news after 4 weeks. I think that is not, you cannot translate this into general unconditional endorsement of market efficiency. But it's relevant, the relevant benchmark for our setting here. So this will be my response to that. I think it at least indicates that when it comes to quite an important example, namely response to earning relevant news, many academics actually retreat to the efficient market view, which I don't know whether they always do this in the rest of their work.
Go ahead, Hector.
Can I just add a quick one on that? So in other terms, my question is, given that most of the actors in the market are not rational, or they do not seem to understand that prices adjust, even if I do understand that prices adjust, am I right in behaving as if prices are going to adjust? Is it a dominant action for me, a dominant strategy?
Well, this is a difficult question, but it is true that households could tend to be right for the wrong reasons here. That actually stale news are predictive of future returns, as they predict, because some people in the economy don't understand or believe in a different model of markets. Now, I think it's a really exciting question to ask. What if we populate a financial market model with different subjective models about the market they operate in? Some could believe in efficiency, some could believe in temporary mispricing, others could neglect equilibrium pricing. How is the resulting market? How does it look like? What are the rules of that market? Who is closest? Whose subjective model is closest to the truth? I think that's a really exciting question that calls for future theoretical work. And there are some really exciting papers that go in this direction. Thanks for the question.
Other questions?
Maybe can I just ask one?
Sure.
I'm wondering how much in particular for the households could also be the case that they simply don't know the definition of a return, so the word return. So whether you might have asked also some treatments where you asked them, is it now more beneficial for you to invest than in the other scenario? If you have done something like that to investigate that.
Yeah, I have two responses to that. I think it's an important concern, and the first thing we do is that we explain what we mean by returns at the beginning of the survey. So that involves importantly both dividends and also capital gains, and then we have examples that we go through with household respondents. The second answer that I have is that we also run a version of the survey where people do not, they also predict returns, but they also make an investment decision. So this is a between subject version. People either learn good news or bad news about a company, and then afterwards they play an investment game where they can invest up to $100, either in a safe bond or into the stock of the company. And this does not necessarily require them to understand the technical term return, but of course they still want to put their money where they think it will perform best. And we replicate our results in such a paradigm.
Thank you. That's super interesting. Thanks.
Like, it would also be useful to write down a model for expectation formation, so that rather than assuming optimal expectation formation or efficient beliefs, we actually model people the way they actually behave,
I absolutely agree with this. Again, I think the question of how equilibria look like with subjective models of the economy, even heterogeneity in that models, is theoretically, it's not only relevant, but it's also theoretically super exciting. So I would love to see more work along these lines. Of course, you need to start, I think that's maybe the difficulty. There are 1,000 ways to think wrongly about the economy, or to think differently about the economy. I think in order to start the theoretical analysis, it's really helpful to understand how people exactly reason about the economy, and that's what we want to achieve in this project. Yeah, so I 100% agree.
Okay, if there are no more questions,
I see one more question by Pedro.
Pedro, you're on mute.
Yeah, no, I'm not. Well, thank you for the very interesting paper. I have just a question. So when we think about anomalies, it's not certain that they should imply temporary only mispricings. Some of them, they would be like that, like momentum or trend following, but in the literature on the quality effect, it could be under reaction to long-term ability of a firm to produce cash flows for its shareholders. So I don't know, how can we disentangle that behavioral bias and the belief that mispricings can stay for a very long time from the equilibrium neglect that the term you use. So is it equilibrium neglect, or is it belief in a mispricing that can be staying for longer?
Okay, so now that's a question that we ask ourselves repeatedly while working on this. And here is our response. So first of all, in people's explanations, if you believe in temporary mispricing, if you believe in a quality factor, then you can voice that in the explanation. And households don't do this. Households just argue in terms of fundamentals. They do not talk about the quality premium, for example. So we do not see any evidence for a belief in longer-term mispricing in households' responses. But the absence of evidence is not the same as saying temporary mispricing doesn't matter, right? So for that reason, I think we also employ other approaches. And the most relevant for you right now is, I think, the experiment that we run with households. And there we have two interventions. One, in addition to the thought to the two scenario descriptions, we tell respondents the risk properties of the stock. Please assume they do not differ across the two scenarios. Okay, so the idea is if households think risk might change from scenario 1 to 2, and this is why they expect different returns, then we shut this down with this additional instruction. And then we have another intervention in which we say, please assume that the stock price reacted to the announcement over the last 4 weeks and fully reflects the available information. And with this, we hope to address everyone who believes in mispricing and shut down this channel. But still, these two interventions, they have no effect whatsoever on what people predict and the explanations they provide. So for households, also based on anecdotal and personal interactions, I have a very strong posterior belief that it's equilibrium neglect and not a sophisticated understanding of the quality premium, for example. For the professionals, for the fund managers, we do see that many believe in temporary mispricing as well. There, it's mostly overreaction that they think the stock market reacted too strongly to the good news, and this is why they expect a reversal and lower return in the future.
So we are out of time. Thank you, Peter. Thank you, Kathrin. You can gauge the level of interest by the questions, and so we could go on forever. And maybe we'll organize another talk on expectation formation very soon. So thank you all, and thank you to the CEPR for hosting this, and hope to see all of you again next month. Thank you for now.